Folks, Tom Lee just said, do this now. In today's video, we are going to cover exactly what famed fund manager Tom Lee just predicted is going to happen next, and what he suggests you should do as soon as possible. And of course, before we get into it, as always, make sure to do your own due diligence on all ideas presented here on the channel, because at the end of the day, if you're the one taking the risk, you gotta be the one doing the ultimate frisk. And today's video is brought to you by our absolutely free email newsletter report. In that first link down below, you can sign up. Make sure not to miss it because we've had some massive runners over just the last couple of weeks alone. And this is completely free that we have to build a relationship with you. Okay, Tom Lee, so context here. Tom Lee comes out on Blood Monday and he makes a few predictions live on CNBC, and we need to cover those in order to understand his latest predictions that he came out with over today and yesterday. He said Monday on CNBC, quote, "The 2-year treasury is signaling the Fed is behind, but it does seem like as we look back, this is from the surprise hike from Japan and the sort of knock-on effects from there," Lee said. "If that is the primary source of the reaction, I know it's going to be tumultuous for markets, but for the US economy, it's not necessarily bad news." So here he was commenting on the Japanese carry trade, saying that, yeah, it's a problem for the Japanese, it's a problem for some of the capital that needed to be liquidated out of the US market, but it's not necessarily bad news for the US economy. He thought on Monday that this was going to play out and the market overall would bounce back, and so far he's been right. There has been a bit of a market attempt to bounce back. But in terms of the bigger picture sell-off that we've seen since July 17th, he said the global sell-off in equities could end up being a mere growth scare. A growth scare, does that sound familiar? Well, it sounds just like the growth scare that we had back in the 2022 era crash, where everything tech, small cap growth related sold off massively. That happened because the Fed was too late to raise rates, and now Tom Lee is making the argument that it's happening again, perhaps because the Fed is going to be too late to lower rates. Lee said, quote, "I think a lot of this depends on whether financial conditions in the US start to tighten, meaning do markets start to seize up," Lee told CNBC's Squawk Box on Monday. "But with interest rates falling and the consumer still in pretty good shape, I think on the other side of this, it'll look like a growth scare." In order to explain this, Lee pointed to what he sees as still robust consumer data and cooling inflation data, and he says those 2 points make him optimistic for a rebound. Now look, it's undeniable that consumer data is definitely pointing in the wrong direction. The trend is bad. And the unemployment is also pointing in the wrong direction. The trend is bad there too. However, what he's arguing here is that even though those trends are bad, well, the overall picture is still robust as it stands today. Robust enough to support more upside should the Fed start cutting rates. He does, however, predict a range-bound market between now and October. A range-bound market is one of the most boring market environments, right? One that just kind of goes like this, up and down within a range. But it's very, very possible that you're going to see a lot of opportunities and big runners in the small cap space, and we'll show more proof of that later on and more evidence that Tom Lee presents here, because that's pretty much his whole thesis. Also worth mentioning, if you didn't notice this, well, on Monday when he went on CNBC, they mistakenly identified his firm as Frustration Global Advisors instead of his actual firm, Fundstrat. Perfect timing since Tom Lee is a permabull, and this was the worst red day in 2 years. And you could see he actually looked pretty frustrated in a lot of the clips, so this was pretty ironic. It kind of reminds me of the time where I had a few little red marks on my face and people started calling me ZipTrader. But anywho, as of late, he's been talking about the VIX. He's been pointing out that the VIX's uptrend has been unsustainable. It hit levels only hit during the biggest COVID freakout and during the biggest freakout in 2008. He insinuated the markets were simply scared out of their minds and panicking, and it wasn't logical. He explained back on Monday that this will pass and VIX will go down, markets will bounce. Now, so far, I'd say that he's been leaning on a successful prediction with that, but the overall trend in markets has been down since mid-July. And today, which would have been the second resurgence day, gave back a lot of strength towards close. So what are his newest predictions? Well, here's what he said since then. He retweeted this post from his firm saying, "VIX falling from 66 to 27 is a positive sign and further sign this is a growth scare with the worst likely behind us. The VIX closed at 28 Tuesday, down from 66 peak intraday Monday. And that Monday reading was the third highest ever after the GFC and after COVID panic lows." And then he had this accompanying picture showing the VIX reversing and being unloaded from its third highest ever reading, and the VIX spot index price dropping aggressively. Now, just a reminder, VIX goes up when people are hedging. They're hedging against uncertainty in their portfolio. They're hedging against very, very big unknowns and volatility that could be right over the horizon, which is why GFC, the Great Financial financial crisis, you got a huge uptick, and then in the COVID crisis, huge uptick. Well, just on Monday, you had the third biggest uptick of that VIX ever. And he's trying to suggest here that this isn't going to be a broader entrenched problem, but is more a temporary growth scare. Now, again, I'm covering what Tom Lee says. I want to give you Tom Lee's opinion here and Tom Lee's breakdown. We could talk about my opinion, different analyst opinion, my neighbor Sally's opinion next week. But today, I want to talk to you about Tom Lee because that's what you came here for. So he's suggesting here that this is just a temporary growth scare. He tweeted this was a rough 3 days of relentless selling, but instead of hashtag breaking equity markets, hashtag VIX is falling. The BOJ, the Bank of Japan, is pausing their hashtag hikes, and stocks are finding hashtag footing, which I assume makes them hashtag bullish. In another post, Fundstrat, the Fundstrat handle, explains the belief that the worst of the selling is behind us. Now, if you dig into Tom Lee's Twitter a little bit, he likes to retweet certain things that he agrees with, and he retweeted this one thing from investment strategist Jim Paulson. Jim Paulson had said some prior stock market calamities show that a rising money supply combined with a declining 10-year bond yield has often provided or proved the elixir for a bull market restart. Once both of these policy conditions are in place, most stock market tragedies are close to ending. Fortunately, the contemporary stock market collapse now has both elements. So what does this mean exactly, Charlie Charlito, who always just wants a rally-to? Well, the statement here suggests that two key financial indicators, the 10-year bond yield and the money supply, are what is going to kickstart the bull market, provide the elixir, the ignition for a broader rally-to. Why would that be, though? Let me break that down for you. Well, for starters, when the money supply increases, there's simply a lot more liquidity in the economy. More money in the economy means that consumers and businesses have more to spend and invest, which can drive economic growth and increase demand for stocks. Pretty intuitive, but what about the 10-year bond yield then? Well, the yield on the 10-year Treasury is a key indicator for long-term interest rates. When this yield declines, it usually means that investors are expecting lower inflation and slower economic growth. As bond yields go down, more people want to pour into equities. So when the 10-year bonds are declining and the money supply is increasing, well, those two factors create a formula for the stock market to go up and do a bouncy-bouncito. Or as they say in France, le rallye, le croissant rallye. Lower yields also make the future earnings of companies more valuable. And they create overall investment because people don't want to be risk averse when there's no risk-free rate of return anywhere else. Now, he also retweeted this fact set here, which gives insight into who bought on Monday. Quote, JP Morgan, the Morgans at JP say institutions bought the dip while retail panic sold aggressively. Retail sold $1 billion, negative 2.5 standard deviations below the 12-month average. Institutions, on the other hand, bought. They bought $14 billion, which was plus 2.9 standard deviations above the 12-month average. Now, remember, institutions make the market. If institutions are the ones buying, they're the ones that are driving the market the most. So if they're buying, they think that markets are going to continue to go up and they are planning to continue to buy. Okay, great, Charlie. So what does Tom Lee think we should do? Now, I know what the title of the video says, and forgive me if you think it's clickbait, but truth be told, he's not going to tell you exactly what to do, but what you can get from him is what he's doing and what he thinks, and then you can garner your opinion on what he thinks you should do. It's not hard to find his real thoughts here because he talks so much as a CNBC contributor, as somebody who's active on social media, and as somebody who goes on frequent interviews. So for starters, Lee has predicted a big rally post-Fed cut. The Fed is expected to cut in September, so there you have that. And in an interview just posted this morning with Bankless, he suggests that September we're going to see not just rate cuts, but the entire economy is going to experience a massive revival. And here's the clip on that. Let's play it.
A true economic catalyst. I mean, that, like if someone says the Fed cutting doesn't going to make a difference, I mean, this is an economy that's been crippled by high cost, and then you're taking that high cost away. That really would revive demand, at a time when the consumer still has a lot of room to borrow money, actually.
So in the context of the drop in market, let's go ahead and imagine for a second that this trend in broader markets continues. It goes down another 5% before September, NASDAQ even more. Well, obviously that's horrible, but if all of a sudden the Fed cuts rates, the economy gets reinvigorated, and then a couple months later, we get the election out of the way, well, that's a whole lot more certainty. And that allows us to get back onto the upward momentum pathway that we may be taking a break from right now. So if you're really reading between the lines and trying to understand what Tom Lee is saying to do, well, it's to do what he is doing, to buy the dip and specifically focus on small cap stocks that have the most upside potential. Remember, it's expected that the Fed is going to cut, not just in September, but by the end of the year, 100 basis points, which means we're going to go from very high interest rates to moderate interest rates. And then if things get really bad, you're going to get back to record lows. Quote, there is going to be a real cost of money decline, Lee said, which should benefit tremendously for consumers taking out home loans, auto loans, and other types of lending vehicles like credit cards and business loans. Bottom line, markets are certainly showing strong signs of gaining their footing, and we also view this panic as ultimately being a growth scare, Lee said. Now, why exactly does Tom Lee like small caps going into this environment? Why has he been such a big believer in small caps? Well, remember, when you're going into a period where interest rates are starting to go down, well, small caps tend to have much higher leverage and higher capital costs, and thus proportionately benefit way more than larger caps. At the same time, Lee frequently likes to point out that the valuations of small cap stocks relative to the S&P 500 are currently very, very attractive, reminiscent of levels seen in 1999. This period marked the beginning of a 12-year stretch during which small cap stocks significantly outperformed large caps. Small cap stocks are also heavily tied to the economy. If you hold the belief that lowering interest rates and printing a ton of money is going to reinvigorate the economy, well, you gotta also hold the belief that small cap stocks are going to do very, very well. Now, in terms of what to buy specifically, well, Lee often suggests the Russell 2000. IWM. This is the benchmark index for small cap stocks, which he thinks could surpass very, very high resistance levels over and over again by the end of the year. And again, he says time and time again that based on today's market conditions, well, if you look at similar market conditions throughout history, well, small caps tend to outperform. What about in terms of specific trades? Well, if you haven't watched our Tom Lee videos in the past, well, here's a little bit of a refresher of what he looks for. He looks for a combination of valuation metrics, whether you're talking about the price to earnings or the price to book. He's looking at earnings and revenue growth. He's looking at market sentiment and fund flows, macroeconomic factors, historical parallels, diversification, so on and so forth. And if you hit all of these criteria, you then have granny shots, which are the top of these. Those are thematic-based stock picks based on 3 general thematic views about the next few years, whether you're talking about AI, automation, or millennials, and the different tastes that millennials have in the economy and how they impact the economy, because different generations have different demand for goods and services and different things they want. Okay, so you go through the list of the Russell 2000 and their top holdings. Some of the top ones that we've identified and covered here on the channel that fit his criteria very, very well are Insmed Inc. and Fabrinet, but he's specifically gone off on SMCI and DEC. And of the two, SMCI for me really stands out. And today they reported earnings and the revenue soared, but the stock dove. I think this is a unique opportunity in a very freaky and panicked market environment to take a look at SMCI. SMCI we've talked about before, but SMCI is Supermicro Computer, often referred to as Supermicro. It's a global leader in high performance, high efficiency server technology and innovation. It provides a wide array of very much in demand services from data center solutions, cloud computing, enterprise IT, big data, high performance computing, and embedded markets. The company is known for its broad range of products that offer high performance, scalability, and energy efficiency, catering to a very diverse set of customer needs across many different industries. If you look at their overall trajectory, especially the last 2 years, well, their business has been very aggressively successful. Also, to put in my own bias here, I really believe that Palantir is one of the best mid-cap stocks out there as well. If you read the earnings yesterday, you listened to that earnings call, oof. But I mean, Palantir reported earnings not yesterday, but a couple days ago, and everything was on fire. Everything that we've been saying, many other channels have been saying too, to be fair, is actually playing out right now. Their AIP platform is killing it, and if you're new, I mean, Palantir is simply a company that provides a platform that analyzes data and helps companies make far better operational decisions. And their proof of concept is in their growth. You pull up some of their numbers, I mean, 55% year-over-year increase in U.S. commercial revenue, 83% year-over-year increase in U.S. commercial customer count, 103% year-over-year U.S. commercial remaining deal value, 98% year-over-year in terms of U.S. commercial deals closed, 9x 3-year U.S. commercial and customer count growth, 152% year-over-year U.S. commercial total contract value. You look at their government revenue, their government contracts with the Department of Defense and others, well, still very steady increases, very good core customer there as well. Sometimes it's difficult to really understand what goes on beneath the scenes of Palantir, but if you look at these numbers for proof of concept and then you look at some of these testimonials from companies that we know, like Fujitsu, one of their high-ranking members said, by creating alert systems, demand forecasting, inventory control systems, and so on, this transformation resulted in an impressive annual cost reduction of $9 million within just 3 months. After they used Palantir, they saved $9 million. That's just one company in one small section of their business. I'm sure they'll save a lot more as they scale it out. AARP, Foundry, and AIP have been terrific for us. We launched the first prototype within 45 days. That was just amazing from my perspective. And you can go on their website and look at their overall numbers and look at how well and how aggressively they're integrating into business after business and improving their overall efficiency and really helping people make those better decisions that actually save money, save time, save from having to hire too many people that do a bunch of jobs that are kind of more busy work. Yes, there's a lot of really hot and lucrative small cap stocks that are still trading at steep discounts and can be scooped up. And I believe that that is what Tom Lee is talking about. Don't miss the forest for the trees just because there's a crash right now, just because there's a dip right now. Whether it turns into a broader correction or crash is yet to be seen, but look at it as an opportunity to exploit mispricings in small caps. And also for those of you who are trading small cap stocks that trade on catalysts, well, don't forget to sign up for our newsletter because almost every single week there's a ton of different stocks coming out with different catalysts and different events, because a lot of small cap stocks right now are running if there's an FDA approval, if there's some sort of big partnership with NVIDIA, so on and so forth. So let us know your thoughts down below, and we will see you in the next video.